And the most important thing about being financially literate is understanding a thing called cash flow. And you can tell the difference between a poor person, a middle class person, simply by looking at their income statement and balance sheets and figuring out which direction the cash is flowing. I will show you the cash flow pattern of a poor person. Generally, a poor person, all they have is a job. The income comes in from the job, goes down, pays the rent, clothing, a little food, then goes out the expense column. Okay, this is the cash flow pattern of a poor person. Welcome everyone. Again, my name is Gabriel Ratana. I'm filling in today for Jason. I love filling in and sharing with the founding father community here. Today, I'm going to be going over the great secret of the wealthy. And these are the basic forms necessary for financial intelligence. One is called an income statement. It has your income and your expenses. It's also called a profit and loss statement. There's also a balance sheet, and a balance sheet has your assets and your liabilities. Okay, so these are the basics for financial literacy and financial intelligence. The main cause of financial struggle is due to the confusion between assets and liabilities. Okay, my definition of an asset is something that puts money in my pocket. My definition of a liability is something that takes money out of my pocket. And the most important thing about being financially literate is understanding a thing called cash flow. And you can tell the difference between a poor person, a middle class person, simply by looking at their income statement and balance sheets and figuring out which direction the cash is flowing. Okay, I will show you the cash flow pattern of a poor person. Generally, a poor person, all they have is a job. The income comes in from the job, goes down, pays the rent, clothing, a little food, then goes out the expense column. Okay, this is the cash flow pattern of a poor person. The cash flow pattern of a middle class person is a bit different. Income comes in the same way, but a middle class family, they probably have a mortgage, they probably have car payments, probably have credit card payments, and it comes up again through the expense column and out that way. Okay, so what you see here are the cash flow patterns of a poor person versus a middle class person. The cash flow pattern of the wealthy is different. The cash flow pattern of the wealthy flows from the asset column into the income column. While the poor and middle class are focusing on income, what the wealthy are focusing on is the asset column. And the asset column is the great secret of the wealthy. For those of us who weren't born rich, okay, and what we have is a job, every time money comes in, this is the point of choice. Okay, right here. This is where you make the decision to be rich, poor, or middle class. If when the dollar comes in, and you take the dollar out this way, then it's your decision. If you go and buy yourself a new t-shirt, cappuccino, a lunch, then you're choosing to expense it right out. You're choosing to be a poor person. If instead, when you get a pay raise or more money, what you do is you go and you buy a bigger house, a new car, or you take a vacation on your credit card, then what you're choosing to do is to be a middle class person, okay? If you choose instead, when the money comes in, if you choose to put it in the asset column, then you make the decision to be wealthy. By putting it in the asset column, at this point, you're choosing to be a wealthy person. But the choice is up to you, nobody else. The wealthy still have expenses, housing, food, cars, vacations, but they are paid with income from their cash flowing assets, not from their working income. Okay, so say you've been working hard and you listen to Dave Ramsey, not to go into debt, and you've saved $60,000 for this Toyota Tundra. Okay, this beautiful Toyota Tundra. Instead of paying cash for the truck, you can go and you can take the $60,000 and you can buy an asset. To keep it simple, let's make it a rental property. Okay, your $60,000 is used as a down payment. So then you finance the car, and your payment is $1,170 per month for 60 months. As long as your rental property makes over that $1,170 per month after expenses, it pays for your truck. If you got anything extra, that can flow right back up to you, and you can pocket that extra difference. After the 60 months, you have paid off the truck, and you still have the property generating you cash flow, and it's probably appreciated. If you would have paid cash for the car, that $60,000 is gone forever, and you would not have a rental property. Okay, but this was just an example. I did something similar. It wasn't a down payment. It was the entire house but it was a house in Baltimore. They're a little bit cheaper. It was a $60,000 or a $30,000 house, but we spent another about 40,000 on the renovations. But it had four apartments in it, and it generated us about 3,200 a month in cash flow, which was pretty nice. There were a lot of problems associated with it, but that was just an example. If you don't like real estate, another option is to buy or build a business. Okay, and then say you put 60,000 into opening a store or a different kind of business. Now you can do a lot of things online that could actually even pay for your living expenses. Okay, I like Airbnb. I still have some Airbnb income properties, but this is all based on what you like. You understand, and you can invest into just different kinds of education or go work in an industry where eventually you can learn and then start your own business. Okay. But what we talk about here at Founding Fathers and the Money Multiplier, becoming your own banker, is that the number one asset for the wealthy is their private family bank. They use that bank to acquire and grow all their cash flowing assets. As Nelson Nash says on page 52, right here, becoming your own banker, everyone should be in two businesses, the one in which you make your living, and the other should be the banking business that finances whatever you do for a living. Of the two businesses, banking is the most important. I know I went a little fast, but I wanted to show you a little bit of the patterns. And for some of you that have been around the campfire, you're probably already flowing money through an asset first. If you already do that, whether it's a life insurance policy or a different kind of asset, if you have money that you have come in, whether it's 5% of your income, maybe 10%, 50%, whatever, here now what I'm going to do is share with you a case study of a family I'm working with. Okay, but essentially this is what we want to do is put the money into policies. That becomes your banking system. That's good, Christian. Yes, and then we use that income, the money in our policies to loan it out. And the best place to loan it, honestly, is yourself. If you have a business, if you're looking to purchase income generating assets, that's one of the best places to loan it. Okay. But I'm working with a family. It's a husband and a wife. He's 56, she's 44. Their baby is 2 years old. So they don't have any life insurance. That's part of the reason they reached out to the team. They saw one of Chris Nagel's videos, and it came in through the system. And I work with a lot of the Spanish speaking clients, so they sent the lead to me. And they don't have any life insurance, and they want some protection. They have 40,000 in savings, and they want to buy an investment property. So we looked at the different options, and what I came up with was we're gonna insure the wife and the husband, but a little bit differently. Okay, so first we're gonna do a policy for her with Lafayette Life, and here's where I made the policy. So this policy is 5,500 per year, and the first year we're gonna take a portion of those 40,000 that's in the savings. They have a high yield savings account. I don't remember the amount, but compared to a life insurance policy, is not going to be anywhere near as efficient. So we're going to put the money in the policy first. And what this is going to do immediately, it's going to get them $547,000 in life insurance in a death benefit. Okay, $35,500. 31,000 is going to be available immediately. At the end of the year, it'll grow to 32,600 because of the dividend. So the dividend the first year is $1,500. And then the dividend will continue to grow every single year. I'm not sure if you guys can see my mouse, but I'm kind of going over the dividend column here. And what's really cool, one of my favorite things about these policies is the cash on cash return. So when she puts in the 35,000, she can use about 32,000 of it. That's 92% that she can access. Okay, good. Right away. Okay, the second year, when she puts in 5,000, and she can break this up if she wants to do it monthly, it'd be about $500 a month, or she can do it quarterly. One of my policies I do quarterly, one of them I do annually. But when she puts in the 5,500, that year she can use 5,700. So that's how much the cash value grows that year. So the second year we're already over 104% on the cash on cash return. Okay, so this policy is efficient the second year, which is really, really cool. The third year, she puts in the 5,500. she'll have access to 6,000. So what they want to do, they want to buy an investment property. Okay, so I'm not sure if exactly if they're doing a flip, if they're doing a rental. So if it's a rental, that income can come in, they can use that to pay back the loan. If they do a flip, they can use that money to purchase the property. And they're in North Carolina, so I know they're priced a little bit differently. They might be a little cheaper than I'm in Maryland here. Things are pretty expensive. But once they do their investment, obviously they intend to make money with the property. They can pay back their loan, and then from there they'll be able to use the money again. But it kills two birds with one stone. It gets them the life insurance that they wanted. They want to have a death benefit and protection if anything happens to them and or to her. Their money is working now. It's not just sitting there in a savings account. And if they just take that money and they go and buy property, sure, they'll have equity in the property, but that money is pretty much gone, right? If they put in the policy first, now they can leverage the policy and use the life insurance money from the general fund of the life insurance company, while their 35,000 is compounding uninterruptedly. Okay. So what's really cool about this policy, I set it up so they stop paying their premium in years when she's 75, year 32. And at that time, they can use it for retirement. So at that retirement time, she'll have $468,000. And the dividend that year is $16,000. Okay, so in year 32, the dividend is three times higher than what the premium would be. And then look at the dividend every single year, it keeps going up. And also, the cash value increase every year continues to go up. Okay. The death benefit began at 547,000, but it's going to continue to grow all the way. If she gets to 100, it'll be at 1.4 million. It continues to grow because those dividends are buying more life insurance every single year, which is compounding the growth. Okay, so at the end, we have 194,000 that she put into the policy of premium outlay. Dividends, she earned 2.5 million in dividends, and in the cash value, it ends up matching what the death benefit would be, which is right about a little over $3 million. Okay, so this is Lafayette Life. If you want a policy where you can do a big dump in and get really high dividends, this is one of my favorite companies. And Jason does a bunch of policies with Lafayette Life. Okay, so this one's really cool. What we did for her husband is we're doing a convertible term. He's still not sure about life insurance, or sorry, about infinite banking, but he definitely wants life insurance. Okay, so what we can do is we can lock in his death benefit because, again, and I hear this from Brent, one of my mentors, life insurance is a privilege. It's not a right. And you actually have to qualify for a policy. Okay, so and if something happens, next year and your health goes, down the toilet or you get diagnosed with something, you might not be eligible for a policy. Okay, you might not be insurable. So with this, we can lock in his insurability, and his premium at his age will be 2,200 per year. So we're gonna do it at 187 per month, and it's a 10-year convertible term. So he has 10 years to be able to lock in this 500,000, and then he can get a policy just like his wife's. You can add more PUA, however we want to do it, but he's locked in and he's guaranteed to be insurable. Sure, with term, if you can see after the 11th year, it shoots up. So 11 year would be 18,000 for the premium, which is really, really, really high. So we want to definitely convert that to a whole life policy before it gets that far. Okay. Do you guys have any questions? I just shared a little bit of an example of for this family. And then what we'll do also in the future is set up a policy for their son. But we can't do a child policy if the parents don't have insurance. So we got to get insurance on at least one of the parents. I'm a huge believer in acquiring skills, and the four money skills that I've kind of tried to just organize is earn, save, keep, multiply. Okay, and this becomes a circle. I've been looking at these policies for a couple of years now. I would like to start one and see what kind of debt I can eliminate. Very good. I'm excited to get started. Awesome, Scott. So, Betty, I'll come back to you in a second. But this goes in a circle. So, we're going to start with earn. Okay. So, we usually have whether we have a job, W-2 income, or maybe we do contract work, 1099. Maybe we're in some kind of sales or doing some kind of side hustle. Okay. When we earn money, and Jason and I are very aligned with this, we want to try to save at least 10% of our income. Before I started infinite banking, I did not save money. I would pretty much just spend it, and I was almost doing investments. I was trying to invest into education, different things to help me make more money. But I didn't have a saving system. And what's nice about having a policy, and actually this family that I'm working with, they were able to save $40,000, but they don't have a saving system. They don't have a set percentage from their income that they're saving. Okay, so a policy is a forced automatic savings vehicle. Okay, so here the 5,500 a year, whether it's an annual premium or they can break it up a monthly. Now they have a system where they're pretty much forced to make this happen. Okay. And this can be from, your income, you can just take a percentage, or if you are into getting a side hustle, maybe you go and do a couple extra hours a week doing that side hustle, and then you can use that money to pay for your policies. Okay. But there is flexibility with this. There is minimum. So if for some reason money is tight 1 month or 1 year, in this example, I believe it's only about 33,000 for like the minimum if they don't have all the 5,500. Okay, so there is flexibility on minimums so that you can make up the money later. Okay, so but you have a set goal and system where you gotta get your stuff together to make sure you can pay your premium. Okay, and we always want to make sure people have a comfortable amount in the beginning, and then you can always scale up later. But you don't want to get to a point where you're overcommitting for these premiums and you don't have you're tight on money and you can't pay them. Okay. Because if you have to surrender your policy or get rid of your policy, there's no guarantee you'll be able to be insured again in the future. And we don't want these policies to lapse. Okay. So we earn our money, then we save it. So you can put this money into a savings account, however you want to do it. But this is where the magic happens. Once we put in a policy, we get to keep that money forever. Okay. Maybe not us, but at least go down to our beneficiaries, to our children, to our children's children. Once it goes into a policy, we don't take them out. We don't do withdrawals. In a savings account, if you have an emergency or you need the money for something, you can access it and take it out. Once you put into a life insurance policy, we don't take them out anymore. If you need to access the money, we access it in the form of a loan so that your original capital is compounding and is not being interrupted by withdrawals. Okay. Now, the multiply, this is where we start to leverage that money and use it like a bank would. Okay. Banks make 500 to 1,300% on the money we leave with them. So we're going to do the same thing. We're going to take that money. And what I like to think of is where can I put that money so that it can increase my earning power? Okay. Whether it's working on a new skill, I've bought, say, courses on, marketing for my jiu-jitsu school. So my goal now, I have about in our transition, we went from at the most, I think we had about 60 students. And then once we decided not to renew our lease and we went to our temporary location, we've dropped to about 20. Okay. At the place we were at, we just honestly weren't getting the walk-in traffic. It was a pretty remote location. So now we're going to a shopping center. And I've been studying and educating myself on how to do different kinds of marketing so that we can pack it out. But, once I get it to about, my goal is 150 students. So 150 students at about 150 a month is what we charge right now. That'd be 22,500 in revenue per month. So that's my goal for us to be at a healthy number. To cover all our expenses, we need to be about 60. Okay, so we're going from 20 and then we're gonna make a push to get to 60 and then to 150. So I'll keep you guys updated. But that's what I do. I invest into skills so that I can increase my earning power. So then I can save more of what I earn. And then once I can save it, I'll put it into policies. Then I'm going to use my policies to purchase assets. But honestly, you are your biggest asset. So you want to invest into yourself, into your education, so that you can increase your earning ability and then you can continue this cycle. But the rest of this, I'll save it for another day. I'm still ironing out the details with this training. But if you guys have any other questions, I'm happy to share. So I have a jiu-jitsu school. I've been a money mentor since 2019. My oldest policy, I think, is about 7 years old. And I'm a father. We also have a family painting business. So that one's actually my biggest company. I'm a part owner in that. Yes, what's really nice about using a policy for debt elimination, say I've accrued a little bit of debt right now when I purchased my farm and we converted the garage into the temporary academy. My cash flow went down by a lot just because there we weren't marketing. I couldn't have new students really join the school, so we just had the ones we had. So I've been carrying a little bit of credit card debt, but now I'm getting ready to pay everything off. But I'm gonna put all the money first into a policy. My one of my policies I have room to put in. I think it's about $8,000 for my one of my PUAs, so the paid up additions. So I'm gonna when I have some of this cash flow come in, I'm gonna put into my paid up additions. Then I'm gonna take a loan and I'm gonna pay off those 8,000 in credit card debt. Okay. By putting in a policy first, say those 8,000, if I were to use it to pay off a credit card, that money would just be gone forever. But if I put into a policy first, now that money is going to be compounding inside the policy. I can use a loan from the life insurance company. I can use that to pay off my third party debt. And when I go to pay back the loan to the life insurance company, it essentially refills my line of credit. So once I pay that all back, I can use it again. With these credit cards, I can pay them off, but there's no guarantee. Is this on my screen share? No, this is just kind of like my personal example. There's no guarantee that I could maintain those lines of credit with my credit cards. I've had credit cards where at one point I was close to like 200,000 in available credit, but as soon as my balances start going up, because I use my credit cards to purchase things, they started just taking away my credit, which now made my credit score really bad because I had 200,000 in available credit, but then I think they cut it to like 50,000. One of my credit cards was like a $20,000 limit. Now it's at $500. So you can't control, what these banks do, but with your policy, it's based off of your cash value, and your cash value never goes down. So that as it continues to accumulate, your line of credit will also continue to increase. And as long as you're playing honest banker and you pay it all back, it'll just be replenished so that you can use it again once you're ready. Okay, but Betty, for sure, this is one of the most efficient vehicles for debt elimination. I'm sure Jason can help you get started and give you an example on with the vault. I know he likes to use the software to show the examples on how to do the debt elimination there. Okay, everyone. Thank you again, Jason, for having me on. I'm excited to share and see this group get bigger and bigger. I know Jason has a lot of really cool things planned. You're welcome, guys. Okay, until next time.